Welcome to The Explainer. Today we're doing a deep dive on PI Industries, India's most valuable agrochemicals company. We've gone through a forensic analysis to really figure out what makes this $7.5 billion giant tick.
All right, let's get right into it. PI Industries has just crushed its competition, but the reason why isn't obvious at all. The secret is actually buried deep inside its business model, and that is exactly what we are going to unpack.
And believe it or not, it all comes down to this one number, 75%. That's the magic figure. 75% of PI's revenue comes from a very specific, high-margin business that most of its competitors aren't even playing in. This isn't just part of their success story. It is the success story.
But hang on, before we get into PI's secret sauce, we need to set the stage. You really can't understand this company unless you understand the world it lives in, and that's India's booming agrochemical market.
And man, what a world it is. This industry is on fire, set to hit almost $13 billion by 2030. You've got a perfect storm for growth here. Huge government support, a massive population that needs to be fed, and a big shift to more modern farming. It's what's making India the world's #2 exporter in this space.
Okay, so now that we know the playground, let's zoom in on the star player. What exactly is PI Industries doing that makes them so special in this incredible market?
Remember that 75% we just talked about? Well, here it is. It's not coming from selling their own branded pesticides in India. Nope. The vast majority of their business comes from this segment called Custom Synthesis and Manufacturing, or CSM. This, right here, is the heart of the whole story.
So you're probably asking, what on earth is CSM? Well, think of PI as a super-secret, high-tech workshop for the biggest names in agricultural science. I'm talking giants like Bayer and DuPont. These guys come to PI with a brand-new patented molecule, and PI's job is to figure out how to make it at a huge scale, exclusively for them.
And here is the absolutely brilliant part. Their whole strategy is built on what they call a no-conflict model. You see, unlike their competitors who might work on generic chemicals, Ike only focuses on new patented stuff for its clients. What does that mean? It means they're never ever competing with their customers. They are always a partner, not a rival. And when you're dealing with priceless intellectual property, that trust is everything.
And this is the proof. This quote from market observers just nails it. Global giants don't see them as just another supplier you can haggle with over a few cents. They see them as a critical, long-term strategic partner who is essential to their own success.
And if you want proof that this partnership model works, look no further. They have an order book of $1.5 billion. That is insane. It basically means they know what their revenue is going to look like for the next 2, maybe even 3 years. How many companies on the planet can say that?
Okay, so a great story is one thing, but talk is cheap, right? Does this fancy model actually deliver the goods financially? Let's look at the proof in the numbers. And wow, do the numbers back it up. The company's performance is just this powerful validation of their entire strategy. It shows this isn't just a theory, it is working, big time.
Just take a look at this 5-year trend. Revenue growing at a 19% clip every year? That's fantastic. But get this, the net profit is growing even faster, at 29% a year. That's the magic formula. They're not just getting bigger, they're getting more profitable as they grow. And you can see that in the huge jump in their operating margins.
So the key thing to take away here isn't just the growth itself, it's the quality of that growth. They're expanding fast, becoming more profitable, generating tons of cash, and they're doing it all with almost no debt. I mean, that is the textbook picture of a super healthy company. And now let's put them side by side with the competition. It's not even a fair fight. Their operating margins are substantially higher than the industry average. Same story for return on equity. They are simply playing a different game, operating at a whole other level of efficiency.
All right, so it's pretty obvious this is a very, very high-quality company, an A+ student. But that always brings us to the central tension of any great investment. What is it actually worth?
Well, the market is definitely not asleep at the wheel here. PI Industries trades at a huge premium to its peers. You can see it right there in the PE ratio, which is just a fancy way of saying what investors are willing to pay for the company's profit. The secret is out, and it's baked right into the stock price.
And that becomes the multi-billion-dollar question for any investor looking at this company today. Is this exceptional quality actually worth the high price tag the market is asking for?
Well, if you crunch the numbers, you get a few different possibilities.
The base case, which is kind of the business as usual scenario, puts the fair value right around where the stock is trading today. But, there are risks. A global slowdown could push it towards the bear case. On the flip side, if they execute even better than we think, that bull case shows there's still a lot of room to run.
So, when you put it all together, the final recommendation here is a hold. And really what that means is, yes, this is an absolutely excellent, best-in-class company. But it also means the current market price seems to have already factored in a lot of that good news. So the reason to own it is pretty simple. You're buying into that unique no-conflict model with its massive competitive advantages, you're getting that incredible revenue visibility from their order book, and you're owning a clear leader in a growing industry that's already looking for its next big act, like pharmaceuticals.
But you absolutely have to be aware of the risks. That high price tag, that premium valuation, it means there is zero room for error. They have to execute flawlessly. And they're heavily dependent on a handful of huge global partners. So if the world economy catches a cold, PI could catch the flu.
And that leaves us with the final big picture question. It's the one every investor has to wrestle with. When you find a business that is this special, this unique, with competitive advantage this strong, do the conventional rules on valuation still apply? That's something to think about.